Okay, let me try and answer some of those questions because I was going to type the messages, but the answers to some of those questions will require my actually showing you charts. Just make it quicker to understand. So first of all, this was from yesterday night. Raphael is our youngest member, doing well. So just keep doing what you're doing, Raphael. I'm really pleased that you're doing this. And then Bucci had won some of his results here. Yeah. And well done, Bucci, again. Just keep practicing, keep trying, keep doing it. And then Lucky Star is this Ayo. And so these are some of your results from today, which is quite good for you. I can see, yeah, some of 12 pips, 22 pips. That was 8 pips, 9 pips, 7 pips, 12 pips, 25 pips. So yeah, keep it at the over the 10 level, 10, 15, and if you can hold it longer, just hold the trades longer. But yeah, you're doing really good here. And then you have some open trades still, where you have yeah, some of them running at 26. Oh no, that's not, that is divided by 3, which is just 8 pips on this now. Okay, so just keep doing what you're doing. I see you. Just keep practicing. That's the way to do it. You're also building your emotional muscle up as you do this. So now I asked a question. What is the single biggest challenge you have when you trade? And then Buchi, you said my psychology, and then I asked you to break that down. And you said, okay, stemming from where I'm coming from and the grounds I need to cover, I tend to want things to happen quickly, so I'm working on myself, knowing that it will happen, but it takes time. Yes, absolutely. So in answer to that question, I think you've got the answer to it. Is actually to start doing it. That is the point. So you've got to leave, you've got to be involved, you've got to get involved, and you've got to just let yourself wait for the trades. Now, it doesn't mean you just wait, fold your hands. It means wait. If you need to do trade management, so things like moving stop loss, taking partial profits, if you need to do that, then yes, go ahead and do those sort of things. But yes, learn to wait. That's the only way to build emotional muscle, by practicing it, by practicing the wait. So all of us, every single one of us, remember, everyone, I say this always, everyone has a money ceiling. Once you have hit your money ceiling, if it is $100, that is your money ceiling. Once you start making above, you see your profit above $100, you'll be tempted to move it. But then to build that muscle, you've got to let it just keep running and stuff like that. And as well, you might be that if you see your account at minus 100, you might want to jump out. Even though your stop loss has not been hit and stuff like that. So you've got to just, the only way is to build that muscle by engaging. Is by engaging, not by more learning, not by more theories. It's just simply by engaging. Yeah, so just keep doing it. And then Lucky says, one more thing, coach, please, I'd like to ask, is there any perfect time frame one can trade in? There is no perfect time frame. Now, there are different reasons why people will trade on different time frames, and price also behaves in certain ways on different time frames. Now, the longer the time frame, so something like the D1, the W1, so the weekly, the daily, the H4 time frames, candles take a bit longer to fulfill. So any strategy you use there, it will take longer to have those candles set up. But the thing about those time frames is, once it sets up, then it is more stable. You might have to wait several days or even weeks for an opportunity to actually develop and give you the complete results. But that's still okay. That's still okay, you know, on the bigger time frame. Now, why would you use the bigger time frame? Now, you will use that for more stability. You know, if you want to have more stable setups. And now, And as well, if you don't have so much time to babysit trades, then the daily time frames, the H4 time frames, okay, even from the H1 time frame, H4 time frame, daily time frame, then allows you that time, because a candle on the daily time frame takes a whole 24 hours to complete. So you will be able to do whatever else you're doing and then come back to spend time, 10 minutes, 15 minutes, to look at the candle, maybe at the close or at the open of the new daily candle. And even if it's on the weekly time frame, then you're looking at a whole week. And so you're looking at several days before one candle actually completes. And remember that price action just happens candle by candle by candle. So that's the benefit of being on the daily time frame. Now, the reality as well is on the bigger time frames, when you have your stop losses, the stop losses will be wider. So when you see a setup, which is typically, I'll just give you an example here, as it were. So if I just take me just a random currency pair, and so on the H1 time frame, you can see if I wanted to take this position here, from there, you can see that it's 58 pips. So 58 pips for a setup like this. If I go on a daily time frame and look for an opportunity like that might be similar to that, which was meant to be a sell trade, so something like this as well. So if I take this and look at that, that is 560 pips on the daily time frame. So you notice that what happens with your stop loss is that it will be wider, which means that your lot sizes will be smaller, or you can then balance that by taking a slightly higher risk trade. So instead of doing 1%, you can do 2 or 3%, knowing that as well, if it goes in your favor, you can see this move down here was 428 pips, but on the H1 time frame, something similar might just be 97 pips. So in reality, the smaller time frames will happen quicker, but as well bear in mind that you have wider stops on the bigger time frame. Now, the very small time frames, if you want to make money very quickly, and then you can start going down to this very small time frame, so the 5 minute, the 1 minute, and even the 15 minutes, because what then happens is you will get more opportunities show up on those smaller time frames. But the challenge with those small time frames is they are well dependent on the larger time frame, and so price can fluctuate even more on those time frames, and but quick profits are definitely on the smaller time frames. You can get quick profits on the bigger time frames. You can get wider, larger profits on the bigger time frames, but you get quick, smaller profits on the smaller time frames. I usually will suggest that if you're starting to trade, you want to spend more time on around the H1, H4 time frame, just to get your mind, into how strategies work, and then you can mix that up with a few 5 minute time frames, but don't spend all your time on 5 minute time frame, because you're trying to make money quickly, because the smaller time frames actually fluctuate more, and then the setups are not as consistent as the bigger time frame. But when they happen, they do happen well. This is 5 minutes, and you can see price just started to take off. Now you might have lost that trade at 13 pips, but then the next one was up here, you made 23, so almost 2 to 1. So you just made your money back. You entered another one there, and you made another 20 pips. Then you entered another one there, and you've just made another 23 pips. So it all depends on you can see we've just taken 3 trades within the same day, in a matter of a couple of hours. You've taken 3 trades. So maybe on a smaller time frame, what you want to do as you learn is to reduce your lot sizes to the barest minimum, and so when you start to make profits, you can then start scaling up. But just and then, as we talk about in the group as well, you can also use the bigger time frames to help guide your actions on the smaller time frame. So you can see what price is doing, the bias, the price movement bias on the bigger time frames, and then that can help you take positions on the smaller time frames and cut out some of the fake setups. So There is no straight answer to your question. It depends on what one is doing. It depends on the strategy. Sometimes our LOB, ERXN, we prefer to trade them on the H1 time frame. I prefer to trade the gap system on the D1 time frame. So sometimes the strategy will determine what time frame you trade. Other times it might just be your circumstance, so you might not have all the time. You might be working full time somewhere and then trading part time, and so you need to be on the time frame that allows you to concentrate on your work when you're at work, and then gives you a bit of time to be able to take the positions when you're not at work. So a H4 time frame and a D1 time frame, or even some strategies on the H1 time frame. So you've got to there is no best. I've seen people make a lot of money on bigger time frames, the larger time frames, and I've seen people make a lot of money on the smaller time frames as well. So it is, and they can do that because they are constantly in front of the computer on the smaller time frame, because things are changing very quickly. Okay, I hope that helps out a bit. And then Assumpta says, I'm still struggling to understand why price goes drastically against the wave. I've lost a lot of trades. I know price will always do what price does. I'm struggling with the emotions, but we'll come off it. I will probably ask you to give us examples of where that has happened, when you say goes against the wave. I would like to understand what you mean, because I'm just on GBP card here, 5 minutes. Let's go to 15 minutes even, and you can see, so price would have been looking for sell opportunities here. So depending on when you caught this move here, even if you went in on a position around, where will I give you, so around here, your stop loss would have been up there. Price came to the 89 EMA but never got to your stop loss, your initial stop loss, which would have been around here. So price never got there, and then you'd have followed this move downwards. Then price came back up, didn't quite get into the wave, and you might have taken this as well, and you got another 35 pips there, and price moved back into the wave, and you could have taken this or taken that one there, and your stop loss could have been around here, and you still got another 36 pips on this, and then you're looking for the next, maybe you wanted to take this one. Your stop loss would have been probably around here, 16 pips. You came about 13 and price took you out, and so you'd have just been tracking this. You're not in any of these positions here. You might have tried to get in here, but then that didn't happen. Didn't get in here, didn't happen. Then here price came down slightly. Now there is an optimization coming on this strategy, where if price breaks the 34 high when it's meant to be on a sell, you need to start getting cautious then. And then if price breaks the 89, which Onka asked a question about that, I'll answer that. I start to look at things differently at that point. So it depends on, I will need to see examples of what you have done that when always goes against you. So you will have trades go against you. It is just the way trading is. But you've got to the strategies you're learning in the club will give you a higher probability, so you higher win rates, so you will have more wins than losses. And then if you start to pick up on the multiple entries, then you can actually multiply your win rates and your profit. And as well, when you're getting into your first position, I always enter small. Take small. Take a very small trade. If price then starts to go in your favor, start adding to the position, as it were. So now this is another one that turned out quite all right. So this would have been the red candle. So this one might have given you a loss, but the second one then, in fact, you might have had two losses. Okay, no, price hadn't turned here, so it was at this point here. You might have gotten here and followed and move up 86 pips against 42, then came back in here again, took another position here, and price just kept bouncing up and down, but there was a 20 pips in this. Now you've got to be looking at price action. Can you see this candle here? This candle, this first one this one here looks like a tweezer, so it pushed down, then the next one gave you a reversal candle straight up. So you've got to be careful here, exiting your positions, and then when price then when boom 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 close below 34, and then this candle here close below 89, then you're changing direction, as it were. So to share some examples, I can give my my view on them. Onka says, when price moves above or below 89 EMA, is it advisable to follow price or wait for a retest, especially on the H1 time frame? What is the best approach to this situation? Now, good question, because on the current, the way the strategy is now, I ask you to do nothing. You have to wait for price to retest. But I'm working on an optimization on the strategy, which suggests that immediately price breaks the 89 EMA, you reverse position. So as an example here, you can see price came down, then that candle there closed below the 89 EMA. I would have put a sell stop at the low of that break candle there, and you can see we just followed it all the way down. Yeah, that's what I would have done. Here would have been about the same thing too. So which one actually broke? So the first close was maybe this, but not a very perfect close. I'll be watchful of this. So the perfect close would have been this. Then our entry would have been at the high of that candle. So we never got a move. So we got this move here, which gave us about 17 pips, but then might have taken us out on the trade with a loss. But then we then had this break above here. We would have put in our stop there, our pending order there, and boom, followed price to that place up there. So this one as well, you got a break here. Your sell entry would have been at the low of that candle, and you'd have just waited for price to continue coming down. That did not happen, so you'd have saved yourself from a fake entry. This one too broke again. Your entry would have been here. It did not fill you in until about here, but then that trade went back and took you out in a loss. Then you could have reversed position and followed this move up here and got yourself some 28 pips. So it's something I'm working on. You will know about it when I come back with my view about it. So keep testing it out yourself, or just stick to the standard entries and rules right now. Okay. So it's good you spotted that, Olga, as it were. What else? Maria says fear of losing. Again, the only way is like a muscle. The only way to overcome the fear of losing is by taking trades. You've got to take trades. You've got to, even though you're afraid, take the trades. And like I always say, start out on your demo account, and then quickly switch onto a live account and determine what account size you will have that is put. You have to agree, you've got to convince yourself that it's possible that I'll lose this money. You've got to accept that. If you don't get to that point where you are aware that you could potentially lose this money and you still get involved in the trade, then you're not ready to take the trade. And it's not just in Forex, any business you get involved at all. There is a potential that you can lose your capital in trading, because folks are just not they don't follow, they're not disciplined enough. People lose more money in trading, but you've got to be ready that some of that profit or some of that capital might be exposed and might be lost. Because when you predetermine what is the worst thing that will happen. If you can convince yourself the worst thing that will happen, you will take the trade based on that size of amount of money you can take as loss. So if you have a $200 account, $500 account, and you want to risk 1% of the account, $500, 1% of $500 is $5. So you've got to only take positions that expose $5 of the account. And you've got to accept that it is possible that you will lose the $5. But when you make profit, you're making 5, 7.5, 10, as the case may be, 15, as it were. So it's a muscle. Build the muscle by engaging, and do it responsibly and by discipline. So you've got to predetermine. Don't take positions that if the loss is coming, then you're actually having a heart attack. It means that you're not taking risk management. So ensure you're following risk management rules and you're disciplined, and then predetermine on every position what you could potentially lose, and accept that that's possible. Then take the position. And it's possible you lose or not lose. And if you have a win rate of about 60%, 70%, then more chances are you will win the trade than lose it. Again, the strategies you have will do that. Yeah. Practice, Maria. So Grace, you said patience is to allow it gain more pips if it's to my favor, and fear and anger if it's against me. The reason again is maybe you're not applying risk management, because if you apply risk management, you'd have predetermined how much your loss would be. Just accept it. You've got to. Anyone that cannot accept this level, you will never be rich. Rich people know they can lose their money. So don't be overprotective of $5, $10, $2. Don't be if you're overprotective of $5, $10, $2, you can't make more than that. So you've got to accept that it's possible that you lose $5, $2. But if you're feeling very bad, it means your risk management isn't right. Yeah, and that's the reason why you're closing the trades early. All of us have to go through this emotional roller coaster, but you've got to it's by practice, as it were. So yeah, I've got to the end of it. I hope this helps, but let's yeah, keep the questions coming. I can record more of this to just try to answer the questions as well. All right, until next time, you take care. Cheers.